So again, thank you for joining us. Happy Tuesday to everybody. Today we're the topic of our presentation is accounting basics to start your business. So I just want to remind you all that please be on the lookout for our training calendar. We are getting together our June 2021 calendar of events. Right now, all we have on there is from June 15 to June 17 at 11 a.m. Winning proposals are a comprehensive guide to responding to federal requests for proposals. Brought to you by the National Center for American Indian Enterprise Development. It's a $225 value course, and you just contact Joanne Nota and for the discount code, and her contact information is on the screen. So if you have any questions about getting the links to or the calendar of events, just contact your local RBDO in Shiprock, Chinle, Church Rock, St. Michael, or Tuba City. So today we're going to talk about starting your business and knowing enough information about your financials to start your business. So, before the pandemic, the Shiprock RBDO, we have a certified trainer, all of our staff are certified to do trainings for Indianpreneurship. It's a entrepreneurship education program for Native Americans. And so you can learn more about the Indianpreneurship program at anwabin.org. So in any type of financial education or business plans education, business plans they're in three parts. There's the marketing, the organization operation, and the financials. So marketing is understanding who your customers are and tailoring your products or services to those customers. Organization operation, it talks about who's going to be doing what in your business. Is your business a corporation, an LLC? Are you a sole proprietor? Are you the only one that's running your business? So that's part of your organization. And then financials. So today we're going to talk a little bit about financials and just to give an introduction on financials. So, I think we won't have enough time to talk about the business financials, your financial statements, your balance sheet, income statement, cash flow statement, and I think this is going to be a continued next month in our training program. So, so when we look at at ourselves as entrepreneurs, or for myself, people who work with entrepreneurs, are we organized? Do you think that you're an organized person? Do you have look at this the tool wall and how everything is organized and in its place? And so and if you're not organized, this might be me sometimes on my desk and talk have things not in their place. So so we're going to talk about getting organized for your financials. So why do we keep record? So we keep financial records for us and our business. So we want to make sure that everything is organized for our business. And once we know that it's organized, then we can use our financial system and as a management tool. We can know if we need to increase the price, if we need more employees, all of that's going to show up in your financials. And So we use it. We use these records and these financial records um, as a management tool for your business. Next one is decision making. So, it helps us make a decision if we need to raise prices, lower prices, if we need to buy a certain type of equipment. These financial records will let us know if the decision is, worth undertaking, or if we should hold off and, not hire someone, or not, um, you know, uh, respond for a larger contract. Also, it helps us identify problems. So if we know that our money's not coming in, maybe we have people that aren't paying their bills. We have employees that are not being as productive as they can. We have if there's equipment that's run its life and not as good as before, then a lot of these problems will show up in our financial records. So help us identify our problems. Excuse me. And one of the last things is the financial statements. We'll talk about this one probably next month, and a little bit about them this month, talking about what kind of financial statements there are and what they're used for. And so another thing that helps us, for our company is forecasting. So if we know we made, $5,000 in June in 2020 or June 2019, 2020 is a bad example. So June 2019, and we made it in 5,000 in 2018, then, it's a good possibility that we're going to make $5,000 in 2021. So it helps us, with the past and knowing what's been our past performance, and help us forecast or know about our future performance. So who do we keep records for? So a lot of times we keep records for our banks, our bankers, and if we want a loan from a bank or the Nation, or some of these CDFIs, these lenders, they want to know how our business is doing. They want a peek into our financial records, and how have we done in the past. Have we been able to pay our bills? Have we been able to sell for a higher price? So these are some of the things that are people that want to lend money. That's what they want to know about our business. And then for your suppliers, so some of your suppliers, they might want to make sure that you're a certain level of business. If you don't have enough business, then they might not want to have you supply their supplies, through your business. They might want to look at your records to know that you're able to, sell what you can of their products. So, and another one, the government. So who doesn't have the government wanting to know about, our financial records, either in business or in our personal finances? So for one is Nation. Nation, we have the sales tax, Nation sales tax. We have the PIT tax, which is the possessory interest tax. And so those, a lot of, the Nation, they want to know what your sales were. How much have you sold last year? And so they want to look into your records, your record keeping, either through a financial statement or so on. So, to be able to let them know how much of that money, you collected is actually theirs. So same with the IRS, the Internal Revenue Service, the US government. They want an idea of how much you made last year and how much you're going to be, how much of that money is actually due them through the taxes. So we do a lot of this, keeping records and such, for our lenders, suppliers, and government. So I want to, have you look at a publication by the Internal Revenue Service. It's starting a business and keeping records. It's publication 583. And if you bear with me, I'm going to see if I can share that in the chat. So this, this is a lot of the information about what kind of business we need to, what kind of records we need to keep is in there from the U.S. government to let us know that we need to keep that information with us for our business. So I've shared the link for download, and then also the link on the irs.gov. So this is the publication 583. It's a publication from the IRS about how to start a business and keeping records for the business. So if you look at page 11 in the publication, we're going to go to page 11 towards the top, well, towards the middle. Record keeping. So why keep records? Well, one of them is to monitor the progress of your business. So you need good records to monitor the progress of your business. Records can show whether your business is improving, which items are selling, and what changes you need to make. Good records can increase the likelihood of business success. So the next one is preparing financial statements. So you need good records to prepare accurate financial statements. These include your profit and loss statement and the balance sheet. So these statements help you in dealing with your bank creditors and help you manage your business. So we're not going to get into much of the financial statements, just to let you know, an income statement shows the income and expenses of the business for a given period of time, and the balance sheet shows the assets, liabilities, and your equity, which is your investment, on one given date. So moving on a little down further, identify sources of receipts. So if you have money coming in, you want to know where those monies are coming from. So it'll help you receive your money and property from different sources. Your records can identify the source of your receipts, and you need information to separate business from non-business receipts and taxable and non-taxable income. So we'll talk a little bit about this later. And the next one is keeping track of your deductible expenses. So as we'll see in some of our financial statements, any of your expenses, they're tax deductible. So so a lot of these expenses, if you're keeping good financial records, you won't forget the expenses when you prepare your tax returns. So, and then the last one is preparing your tax returns. So, with the Now Nation, most businesses they pay every quarter, so they have to keep the records and the financial records. And then with the federal government, you have to pay do tax returns every year. So our financial record keeping system helps us do that. And the last item, it helps us support items on our taxes. So if we have a deductible expense and we know it's deductible, and you just need to keep those records for the IRS. And if the IRS requests to examine any of your tax records, then you and explain some of your items on your taxes. So if you have a comprehensive record keeping system, then it'll help you do that. So if you have any questions, you can ask, unmute yourself. If you're calling in on a phone, then you can unmute yourself with *6. So we keep records to monitor the progress of our business as a management tool, and then prepare our financial statements, to identify the source of receipts, to keep track of deductible expenses, and to prepare our tax returns. And once we prepare them, we can support the items reported on those tax returns. Excuse me. So that's from page 11 and 12 of the IRS publication 583. So let's move on. So everybody knows, April 15th as tax day. So, so what is tax day? It's the day that we have to let the IRS know how much we made last year and how much taxes we paid, and if we have to pay more taxes. So this year they changed it to May 15th, and last year I think it was July 15th, but that was because of the pandemic. But normally tax day is on April 15th. So what does that mean? So that means, anything that you make by December 31st, you have to report that to the IRS by April 15th. So December 31st, everything kind of stops. So, all the sales that you make, in December 31st is the day that, your, all the money you win at the casino, all of that money that you receive from certain places, from your jobs, all of that money up till December 31st is reported to the IRS on the April 15th. So December 31st is, the end of the financial year, for all of us in our personally. But for a business, they can choose when their financial year ends. They can choose and say, I want my business year to end on June 30th, or I want my business to end on September 30th instead of December 31st. So for Navajo Nation, their financial year, it ends on September 30th. So, so that's their end of the financial year, as their end. That's their fiscal year. So when you're starting your business, you want to let the IRS and folks know that the end of your financial year is this date or that date. It can be December 31st, it can be June 30th, be September 30th. So you need to let them know what your fiscal year is. So let's look at page 4 in your publication 583. At the bottom has designating a tax year. So you must figure your taxable income and file an income tax return based on an annual accounting period called a tax year. So a tax year is usually 12 consecutive months. So there are two kinds. You can choose the calendar tax year, which is, ends December 31st, then you start again on January 1st. Or you can choose another fiscal tax year. It has to be, 12 months. So it could be, June 30th or September 30th or another, certain date. So that's something that you have to let the folks know when you're starting your business, is what is your tax year. Calendar year and fiscal tax year. So your calendar tax year, that's usually for your personal taxes. You keep books and records, but there are certain situations where if you don't keep records, then you automatically bump to the December 31st tax year, and you have no accounting period. And the fiscal tax year is you choose when your business financial year is over, and anything within is taxable within that year. So let's look at a calendar. So what happens during the year for our business? So, for example, in October here in Shiprock, New Mexico, we have the Now Nation Fair, the first part of October. But last year it didn't happen. I don't think it's going to happen this year, but maybe in 2022 I'll be back. So a lot of people plan for the Now Nation Fair, Northern Navajo Fair, and so they make a lot of inventory to sell at the fair, and so in December, what happens in December again? Christmas time. So a lot of people, they make a lot of inventory. If you make rugs, they make rugs. If you make pottery, they make pottery, and they do a lot of manufacturing in anticipation for December. So let's say if, you have a squash blossom, that kind of thing, or you sell rugs. So if you're at the flea market, or you're trying to sell some jewelry or rugs, and so a lot of people will want to sell their inventory during that time of year. So let's say you have a squash blossom that's $1,200. I don't know if that's a good price, but let's say it is. And let's say there's you are looking to sell it, you're looking to get money for it, so you can have a good Christmas and such. So if somebody says to you that I'll give you $400 on New Year or Christmas Eve, and then I'll give you the rest of it, in January and February. So do you all, I'm not sure if there's any of you all that will sell that on basically on credit. So, but there's some people that do, especially if they have, like the larger items like $1,200 squash blossoms or $600 rugs. They'll sell it on credit. So they'll do that. So they'll give you $400 on Christmas Eve, $400 on the first or second Friday in January, and then they'll give you the last $400 on February 5th. So some of you might do that, some of you might not do that. So what do we look at for these payments? On $400 on January 8th we got 400, and then February 5 we got 400. So for 2020, and we're saying that our end of fiscal year is December 31st. So that $1,200 is split up. So do we say, we got $400 in December, and then we got $400 both in January and February. So we can tell the IRS that our end of financial year is December 31st. So I got $400 in 2020 and $400 in 2021. Also, we could say that we got all of our money in $1,600, I'm sorry, $1,200, right? Except, so we can say that we got $400, $1,200, the entire portion in 2020. So that, that's not really the case, but we say, we can say that because it's a different financial term. So we say $1,200. So we can say, we received $1,200 in income in 2020, and we can tell the IRS on April 15 that $1,200 was received in 2020. Or we can say $400 were received in income and $800 in 2021. So the first one is called the cash method. So we can say, that we received $400 cash in 2020 and $800 cash in 2021, and only report the $400 that was actually received as cash in 2020 as taxable income. Otherwise, we can say that we received $1,200 in 2020, and we would report that income as taxable income, and none of it was received in 2021. and that would be the accrual method. So there's, the cash method and the accrual method. So that so it all depends on when you want to report that $1,200 as taxable income, as 400, 800, or $1,200 as one thing. And that's, remember your end of your financial year, December 31st. So let's look at page 5 in publication 583, and towards the bottom. So you're choosing an accounting method. So an accounting method is a set of rules to determine when and how income and expenses are reported. So you choose an accounting method for your business when you file your first income tax return. So there are 2 basic accounting methods. The first one is the cash method. Under the cash method, you report income in the year you receive it. You usually deduct or capitalize expenses in the tax year you pay them. Or the accrual method. Under an accrual method, you generally report income in the tax year you earn it. So you earned all that money, all that $1,200 for the for your jewelry. You earned that all in 2020, so you want to, pay your taxes on it right away. So that's the accrual method. So under an accrual method, you generally report income in the tax year you earn it, even though you may not receive payment in a later date. So you deduct and capitalize expenses in the tax year you incur them, whether or not you pay them that year. So, so I just, if you're new to, starting your business, then, probably the cash method is probably for you. But I think, a lot of the larger companies, they'll have, whole departments looking at, and they have different methods for how they do their accounting. So those are some of the differences for the cash and accrual. So impact for the cash, impact of the transaction is not recognized until the cash is paid or received. So you didn't earn that money until somebody gave you cash for it. You didn't earn it until January and February, even though they took it, and you let them have it for the $400 cash down or something. For the accrual method, the impact of transactions are recognized as they occur. So, this can happen also with insurance. So if you buy insurance, you usually buy insurance for 6 months at a time. So, do you say it's an expense, all of it when you pay for it, or all of it, throughout the year? So it, determines your sales and your expenses. So again, if you have any questions, you can ask in the chat or unmute yourself. If you're calling in, you can dial *6 and unmute yourself. So this is the Form 100 from the NAVO Tax Commission Designation of Individual. So if you look at towards the middle of the page, it'll ask you what month end is your accounting year. So if you have a fiscal year that's different than the calendar year, make sure you put that for your fiscal year, financial year ends on June 30th or September 30th or March 30th, then you want to let them know, and they require that information when you're setting up your nomination sales tax. Look at number 6. Number 6, they'll ask you, what method do you use for your accounting records? And there's 2 options there: your cash method or your accrual method. So, if there's any questions about the tax year or accrual method, or the accounting methods, then please let me know. So moving on, so we want to look at the business transactions. We want to know, what kind of transactions do we do every day of our business that we want to keep track of. So here are some. If there's a sale, if we sell a fry bread, or if we sell a piece of jewelry, if we sell some type of service, then we want to make sure that we keep a record of that. So if we keep a record of it, if we receive cash, so we want to make sure keep track of our cash sales. If we give somebody credit and tell them that they can pay in a later date, then we want to keep a record of that, right? If we have accounts receivable, that means if people owe us money, then we want to make sure that we keep track of who owes us money and how much they owe and how much they still owe. Same way with your accounts payable. If you're buying something on credit for your company, then you want to make sure that you want to keep track of how much you still owe and how much you pay them. Anytime we receive money from somewhere, if we get a loan, we want to keep track of the loan. We want to keep track of any type of money that comes in, any type of payments. If we pay a utility bill, we want to some type of records of where that money went. Same way with payroll. If payroll is really a big thing, because we want to keep track of how much money they earn and how much money they get, and how much money does the state get, how much money does the IRS get. So of all that money that they earn. If we purchase supplies, purchase inventory, purchase equipment, we want to keep track of those purchases. Depreciation, if we have a truck that we bought in 2000 for $50,000, and it's 2020 or 2021, that truck is not worth $50,000 anymore, because that value went down with age. So it's that's what they call depreciation. So I'm not going to talk much about the accounting entries, but just realize that there's some transactions that we do at the end of the month or end of our accounting period. So how do we keep track of something? Personally, I mean, this is a diary. So, it's not my diary, but we can keep a financial diary. So that's how we keep track of things that happen in our lives. So we want to keep track of what happens in our the life of our business. So we have a diary. So what do we do? What do we put in the diary? Dear diary. So When did it happen? This is what happened today. Today is 5/25/2021, May 25. So we want to, if we have something that happens today, if we paid a bill, we want to make sure we put the date in there. If we made a sale, we put the date. And then what happened? I sold a fry bread. I sold a car. I bought a piece of equipment. What happened? You want to, did it happen with cash? Did you pay payroll? Did you pay a bill? Did you buy inventory or supplies? Those are things that, you want to put the date and what happened. So dear diary, on May 25, I paid payroll. I paid them in cash. So let's say we have the cash and we keep track of just the cash. So we say, oh yes, 35 $35 came in today. $35 went out yesterday. So we want to, keep better records of where that money goes. So if we get $1,000, what is part of that $1,000? If we, $1,000 goes out, what is that $1,000 for? So if we have money coming in, it could be an investment. Somebody gives you money for part of your business. If you have sales, $100, $1,000 for, a rug, or somebody gives you a loan. So that $1,000 could be for any reasons. And the same way with the other side. And we can't just keep track of just the cash. So we keep track of payroll, utility bills. Anytime we pay our taxes, we want to keep track of it and make sure that we have records of what taxes were paid. So if we keep track of cash and any of these other items like sales, then we say $1,000 came in with cash and we made $1,000 with sales. On the other side, we paid $1,000 in cash, but that $1,000 is also payroll. So there's two parts of that transaction. So, single entry versus double entry. So if it's a single entry, then we're only talking about cash. And if we only talked about cash and made a record of just our cash, then we could we have that information only on the cash. But if we say it's $1,000 in cash and $1,000 in sales, then those two, and we keep track of both of them, and we make an entry for both of them, then it's what they call a double entry. So there's two entries for one transaction. So single entry is one journal entry for each transaction and records only the active account. So the active account is the cash. And your bookkeeper or your accountant, they'll have to figure out where that cash went. So they have to reconcile it. A double entry accounting system means there are two journal entries for each transaction. And it's easier for the accountant or bookkeeper to reconcile those transactions. And it's easier for them to find any errors there are. And so there's a check and balance in a double entry accounting system. And it's the basis of a true accounting system. So when we say we want to keep track of sales, keep track of our payroll, so we put those into different accounts. So we have to think about, what do we want to keep track of? And what do you want this account listing or their chart of accounts to include? So your chart of accounts or your listing of accounts has to have the ability to track accounts you want to track. For example, you can say you can have a sales account for each line of products or range of services. For example, I want to keep track of my fry bread, and I want to keep track of my bowls of mutton stew. So you could say, I don't really want to learn all that much about it. I just want to keep track of food sales. So you can say food sales, or you can keep track of each line of product. But most times you don't want to keep track of each product's sales. So what we do is we categorize these different accounts in our listing of accounts, in our chart of accounts. So we have them as assets, liabilities. Assets is what you own. The liabilities is what you owe. So if you got a loan from a bank to start your business, then you have a liability to that bank. So you want to keep track of that. And then your owner equity. Your owner equity is your investment into your business. So if you didn't go to a bank and you just started your business with $10,000 of your own cash, you want to make sure that that $10,000, you want to keep track of it and say, that $10,000 is my owner equity. That's my investment into the business. So every month, when you start making profit and you start making money, then the money that you do make, you have to keep track of that in your owner equity or your investment category. So you do a chart of account for your owner equity. The next category is revenue. If I sell, if I have food sales, I want to keep track of that, those sales. If I'm a construction person, I can have, remodeling sales, or, what kind of sales do you want to keep track of? And you put that in the revenue account. Your cost of goods sold is, how much money does it cost to make what I sell? So for example, if you buy, or if you make your jewelry, then the silver that you buy, all the supplies that you put into the jewelry, and your labor, it all gets recorded into your cost of goods sold. So if you're, buying sneakers and selling sneakers, then when you buy the sneakers at some supply company, that is also your cost of goods sold. So cost of goods sold could change depending on the type of your business. And then the last is your expenses is anytime you have a cost for your business, and you spend money to be in business, that's your expense. It could be a marketing expense. If you go to the if you have a spot at the flea market, then any type of spot or fees and telephone fees, any type of that kind of thing, those are expenses. So you want to keep track of those. So this is a graphic that I use in some of our presentations here at the RPDO, and so I'm gonna put that in the chat, and it just explains a little bit about the explains a little bit about the bookkeeping process and that and all. So, see, I've pasted down the download. So if you look at the top here, it talks a little bit about single entry and double entry accounting. So up here, we talk about single entry accounting. So here's some examples of single entry accounting, like a cash disbursement ledger is probably a good example of a single entry accounting. Check register is a good example of it. So you're only keeping track of, let's say, cash or your checks. So, all those, checks are written against the money that's in your account. So you're only keeping track of that. So that's only one part of the a single entry. On the other side, double entry accounting is a system of record keeping based on the relationship of business resources and the sources of those business resources. So your cash account is going to be your active account, and what it reflects on some of the other resources within your business is your passive accounts, and so we keep track of those. So this is the accounts. We have assets, again, what you own, liabilities, what you owe, and your owner equity, which is your investment, and this 100, 200, 300 accounts. So this makes up your balance sheet. So those three different types of accounts make up what goes into your balance sheet. And then the other ones are your 400, 500, 600 accounts. Those are your income, your sales, and then your cost of goods sold. Anything you buy or purchase that goes into your products, that's your cost of goods sold. And then your expenses. So and all those three categories of accounts go into your income statement, or they call it a profit and loss statement. So here's the a formula on how the financial statement is laid out. It's gross income minus your cost of goods sold minus your expenses, which equals your net profit. And then your balance sheet. So your balance sheet is your assets on one side, and then your liabilities and owner equity on the other side. So So if you have any questions about any of these, then let me know, but we'll probably talk a little more about this in our next presentation. So again, like I said, your assets, liabilities, owner equity, those are your balance sheets account. Your revenue, cost of goods sold, and expenses are your income statement accounts. So whenever we keep good records and make sure that they're in the correct categories here, then you have the basis of what you need for these two financial statements for your business. So if you're doing your record keeping by paper or by computer or by QuickBooks or some online service or app, then one of the key things is making sure that your chart of accounts, your listing of all these accounts needs to be entered correctly. So, talk with a bookkeeper, talk with an accountant about setting up these accounts and how you want to keep track of these, different items for your business. So let's look at a truck payment. So let's say we pay $600 a month for a truck. So if we just kept track of the cash and we said we paid $600 to the credit union in cash. So that's just a single entry. But if we look at it in as a double entry accounting transaction, then we pay $400 for principal and $200 for loan. So if you ever had a loan and you got a loan from someone and you pay $600 a month, a lot of times those loan payments are broken down every month, and you pay interest and you pay principal on the loan, even if it's $600 a month. $600 a month. Part of that $600 goes to the original amount. In this case, it's $400, and any interest on that you're paying for the loan. So in this case, it's $200. So even though it's still $600 cash every month, so these amounts will change every month and how much you pay in interest and principal. And why this is important is that if you look at, your two different financial statements, one is your liabilities, which is a balance sheet account. And then the other one is an expense, a 600 account. And we again look at the payment. We have a 600 account and then the liability account for 201. So we are paying back a loan for $400. That's just the principal, the original amount of the loan. And then 600 is the interest, and that's $200 a month. So that loan interest, that is actually tax deductible. So you get to, when you're doing your taxes on April 15, 2021, that loan interest is the only part that is tax deductible. You can't deduct the $400 from your taxes. So that's why it's kind of important to do, the double entry. Which accounts does that $600 affect in your accountings? So I'm at an hour right now, so just going to share this screen again and talk about the balance sheet and the income statement. And so next month we'll talk a little bit about that and talk about our pricing Hope to see you all next month. And if you have any questions, be sure you can ask them now, or you can look over the information and um, and uh, and ask them next month. So we didn't get through to the cash flow, but we'll do that next month. But again, a business plan is, talks about marketing, organization, operation, and financials. So we're going to talk a little bit more about financials next month. Again, this is the June calendar of events. We have winning proposals, a comprehensive guide to responding to federal requests for proposals on June 15, June 16, and June 17. Joanne Nota, she's in the audience if she wants to talk a little bit about it. But you can contact her for the free code. But as always, you can contact any of the RBDOs for information about the webinars, these webinars, and if you have any special requests for webinar training. For example, if you want to know how to incorporate, let us know if that's something that might interest you. Just another set of news is our Now Nation Economic Summit. It has been postponed until 2022, but just keep your lookout for more information about that. But if you have no other questions, and if you have no questions with Joanne talking about her presentation in June, thank you for being here. If you have any questions, please let me know. If you would like the presentation or any of the documents that I shared, then let me know as well. But thank you for joining, and we'll see you next time. Bye-bye.